Hi, thank you for joining today's webinar. My name is Dave Mantell with Stabler Wealth Management. For today's webinar presentation, we will be covering 5 year-end tax planning moves for Microsoft professionals. As we're now in November, this is a great time to review your list, top off any final actions to take, and end the year strongly. So with that, let me share my presentation screen and we will jump right in. All right, here we go. Okay, perfect. That looks like it's showing now. Great. Yep. So as mentioned, 5 year and tax saving strategies for Microsoft professionals. Thank you again for joining today's webinar. As we launch into the presentation here, we'll just start with setting the tone a bit in terms of why this, especially in 2025, is a real critical year for tax planning. And so right off the bat, we have new tax laws this year. So for those that have followed the big, beautiful bill, I'll probably refer to it as a big bill to shorten it up throughout the presentation, locked in these historically favorable tax rates that we've had, really the last, going on 8, 9 years. And that applies not only to income tax rates, but estate taxes also from a federal perspective. And so these lower tax rates we've been having will continue on not just for 2025, but for next year as well. With that new big bill tax changes that came into play, beyond continuing the current tax rates, another key item there that's going to impact many, especially if you live in a state with a state income tax, California, for example, Oregon, New York, is that the SALT, so state and local tax deduction cap, they upped it. So these past several years, you've only been able to itemize up to $10,000 of property tax. And so that's now up to $40,000 for those that qualify. And so that's could be a pretty sizable change on many folks' tax return and tie into a lot of other factors. One of which is charitable. So another change, they've added a charitable floor starting next year. So beginning next year, the first 0.5% of gifting that you do for charity, you don't get a deduction on. So again, 2025 clock's ticking a little bit for that window to continue. And then from there, so this is a really big one. While not fully tax related, it does tie to your tax return quite a bit. But starting next year, it's looking like we're going to see an expiration of the post-COVID rules for early retirement health insurance. And what I mean by that is for the past 5 years, uh, the way it works is everybody starts with a health insurance tax credit for those that are retired, but not yet of retirement age for health insurance Medicare. And so everybody receives a credit, and then that credit falls off over time as your tax return income increases. Starting next year, it's looking like we're going to go back to the cliff, where basically, if you have over 85,000 of tax return income, then you're paying the highest level of health insurance premiums between retirement and getting to age 65 Medicare. And so there's some really critical planning you could do ahead of retirement that gives you a lot more flexibility to keep your health insurance more reasonable in those early retirement years. So here's a few things that jump to mind, which makes 2025 a pretty crucial final, month and a half of a year here to implement some key tax planning strategies that can really set your retirement plan up for better success. Okay, good. For this presentation's catered towards Microsoft professionals, and there's a few key items working at Microsoft that are especially applicable to you that we're going to cover in today's presentation. First of which is a big part of your compensation is in stock awards. So RSUs, restricted stock units. And so between that and cash bonuses that you receive, it creates quite a bit of uneven income beyond your salary. And as a result, we see it commonly where it's hard to get the right amount of tax withholding, results in a lot of surprises. So we'll go over some key considerations and techniques there to avoid a tax surprise for 2025. Um, with that, Microsoft's got great benefits, both in terms of contributions to the 401k, health savings accounts if you're on the health savings plan, and there's a lot of different, ways to really make sure your savings are adding the most leverage as possible and the most tax benefits to get the most out of that. And so we'll go over those key items to look at and top off your list by the end of the year. I talked about, many folks at Microsoft tend to under withhold taxes, as the baseline withholding on your stock awards is only 22%, which typically doesn't cut it. And we'll go over in this presentation basically 5 key takeaways that you can take with you to make sure you're leaving this meeting with a game plan to save taxes, enhance your wealth picture for 2025 and beyond. Okay, very good. So before we launch in, just a few items about us. So at Stabler Wealth Management, we are financial planners. We specialize in working with Microsoft professionals, especially helping you ramp up a great retirement work optionality plan, and then having you transition and successfully make that jump into work optionality and retirement. We have a team of certified financial planners, CFPs. That means we are fiduciaries, and we always have your best interest at mind. And our whole thing is bringing that together is how can we provide personalized advice to you to just drive better outcomes for you and your family and make sure we're doing everything we should be financially to set yourself up for success. So in addition to this webinar, we continue to do regular webinars going forward, as well as monthly articles. Many of you receive our Microsoft Money Moves piece that we send out at the start of each month. But go ahead and check out our website, www.stablerwealthmanagement, and you can go to the Insights page, and that will take you right to all the content we're putting out directed for you. So give it a look when you have some time. Okay, so with that, let's launch into the 5 key strategies to be working on here at the end of 2025. Okay, so strategy number 1, and this is a beefy one, so get ready, but basically max out your tax advantage accounts. I've hit on it earlier in this presentation, I've hit on it before. It's not just what you earn, but what you keep that matters when you're investing. And so whatever we can do to minimize taxes and have more of your earnings end up in your wallet is really a key foundational piece to building wealth and setting yourself up for retirement success. So first things first, max out your 401k, especially that first 23,500 you can put in. And, with that in mind, Microsoft matches 50% of that. So that is free money. So you want to make sure at a minimum, you're making that 23,500 contribution this year. And because that basically allows you to earn a 50% return day one on your money when you account for Microsoft's match, right? The 50% match. In addition to that, if you're age 50 or above, you could do another 7,500. And you can do this either the pre-tax, the Roth, or a combination. And so that's something especially that you want to be doing to get that tax advantage treatment. This is a newer rule here, but if you end the year between age 60 and 63, they increase the catch-up. We'll call it a super catch-up, where rather than 7,500, you can do 11,250 on top of the 23,500 into your 401k. And so that's a really, strong technique to do. I mentioned the Microsoft 50% match. Don't say no to free money, right? So you want to make sure that you're getting that on that first 23.5. And then, another nugget. So in addition to 401ks, the health savings account is one that goes under the radar a bit. You need to be in a high deductible health insurance plan to qualify. So that's the health savings plan at Microsoft. But essentially, it's sort of like a 401k on steroids. So even though it's a smaller amount that you can put in, You know, 85, 50 for a family plan, another thousand if you're age 55 or above. The money you put in your health savings account, you get a pre-tax. You get a tax deduction right off the bat. You don't pay tax on the amount you put in. The growth on that grows tax-free. And then you could take it out tax-free as well, as long as it's used for permissible, health-related expenses. But it's a pretty wide net that you can use it for. For example, for a lot of clients that we work with, will you view the health savings account as your health insurance retirement expense coverage once you hit Medicare age at 65? Because you can, one, contribute to a health savings account up to age 65, even if you are no longer working, as long as you're in that high deductible plan. And then two, you can use your HSA account for Medicare premiums. And as we know, health insurance expenses have gone up dramatically over the years. I don't think they're going backwards, right? Probably we're going to see more of the same. And so by building up that retirement health expense nest egg in that health savings account is a really great, head start on retirement, having much of that, expense that we know is coming earmarked accordingly. So the HSA account, again, is a great technique. And so, as we kind of go through those buckets so far, again, 401k, you could either do a pre-tax or traditional. The way the pre-tax works is when you put money in, you don't pay tax on that money today. So that helps your tax bill today. But then when you take the money out in a pre-tax 401k, you pay tax on it when it comes out in retirement. The Roth's the opposite. So if the Roth, you don't get any tax deduction when you contribute the money up front, but once it comes out tax free. So the money that's in there, all the growth, when it's accessed, if accessed in the right way, there's no tax on it. So it grows tax free. The HSA, you get both of those things, right? The pre-tax savings, and then all the growth is tax free as well. The mega backdoor Roth, this is sort of an above and beyond. And so Microsoft, Amazon, Boeing, a lot of companies have started offering this in recent years. But in addition to the 401k, regular plus catch up that we went through in that first portion, you are able to put in another, 20,000, 25,000, in some cases, 30,000 into your 401k. And so that's pretty substantial when you think about that. Um, First glimpse, it doesn't go into the pre-tax or the Roth bucket directly. And so it takes a little bit of nurturing. But essentially, what that does is that additional chunk of money goes into your 401k after tax. You can make the election for Microsoft to convert it to Roth immediately, which allows it to therefore, get into that Roth bucket where it grows tax free. And so that's why they call it the mega backdoor Roth. It's a way to add tens of thousands of dollars a year into your Roth bucket, regardless of what income you're at. Somebody, what it could be, you can be making $1 million, right, and still do the mega backdoor Roth. And so it's a really powerful way to save on top of those other buckets that we noted. Okay. Um, and then lastly, the regular backdoor Roth IRA. So this is outside of your 401k. It's in your regular retirement accounts, but you can essentially, contribute to your regular IRA. The reason you do a backdoor Roth instead of a direct Roth contribution is if your wage earnings, your earned income is too high to contribute directly to an outside Roth account. You could contribute to an IRA. You don't get a deduction because your earnings are too high, but then you could convert that to a Roth IRA thereafter without tax. And so again, the amounts, you could do, 7,000, 8,000 if you're age 50 or above. So it's not as much as a mega backdoor Roth. But when you add this whole list together, it's quite a bit of funds that you could invest in a tax advantaged manner. And if you do this for a number of years and kind of build those together, that will really change the complexion of your retirement. So a great technique to be thinking about and working on. Okay, good. Um, all right. So with that, as we went over the different strategies to focus on, for tax advantage accounts and strategy number one. That takes us to strategy number two of the year. And so this is charitable giving and what the big beautiful bill did to that and how to best optimize given the current landscape that we're in. Okay. Okay, so first off, two main focuses of the big beautiful bill. First is we're going to continue to have the lower tax brackets that we've had. I know when I'm saying low, many of you are probably rolling your eyes because we all pay a lot in taxes, of course. But compared to some of the historical tax rates that we've seen, especially if the amount of debt levels, that our country and really the world has for that matter, the current tax rates are quite favorable. And so, for example, a couple can earn roughly 400,000 of income and be in the 24% tax bracket, right? Which is a very reasonable tax rate, especially if you're in a state like Washington that doesn't have a state income tax. Um, the highest tax bracket is 37%. And again, historically, that's quite low. We've been in portions after world wars where the highest tax bracket was over 90%. 90, right? And so 37% is very reasonable. And so those taxes are going to continue on and have been, made permanent. I do permanent in air quotes because as we know with any tax laws, they could always be changed as we just experience. And so next time we have a political shift, right, we could very well see, the tax rates change. And so again, these are today's tax rates. In addition to that, the bill also increased the SALT cap. I provided a little bit of a teaser on that earlier in the introduction, but essentially, right now, you are limited at $10,000 that you can deduct from your taxes for either property tax or state and local income tax. And so, where property taxes are, not to mention if you live in a state with an income tax, that 10,000 is hit really quickly. So as a result, a lot of people have been itemizing on their taxes, recently. Um, taking the standard deduction instead of itemizing on their taxes. Now it's the other way, right? More people are itemizing. As we've seen, you can deduct up to $40,000. Between state and local tax, charitable giving, mortgage interest, health insurance deductions. It's many folks will now be hitting that standard deduction when they didn't previously. And so with that, charitable giving can be in play for a lot more folks where you actually get a tax benefit for it. Because previously, a lot of folks may give to charity, but if you're still taking the standard deduction, it actually doesn't help your tax bill. And so, this opens up some more avenues to do so. I will note with that SALT cap, the state and local tax deduction, that 40,000 is earnings based. So if your tax return income is over 500,000, that starts to phase out and works its way back down to 10,000 cap at 600,000 of income. And so it's important to be thoughtful just on your tax return income, especially when you're thinking about, RSU vest, selling stock, selling properties, things like that. You want to be a little bit thoughtful because that could sneak up on some folks where you could lose that higher deduction level. Okay, good. So with that, donor advised funds are a great technique when it comes to charitable giving and planning. And there's a couple reasons for that. One, in a higher tax year, you can bunch more years of charitable giving into one, but still deploy it in the manner that you want. So the way a donor advised fund works, it looks like another account, investment account, same way as your other, IRAs, Roth IRA, brokerage account. It's another investment account that you control. When you put contributions, so when you fund that account, at that time you get a tax deduction. So that is a charitable deduction that you could take on your tax return when you put the money into the donor advised fund. You can then decide how to disperse that to charities over your liking, Could be over 2 years or 3 years or 5 years, however you want to spread it out. And so it could be really impactful to bunch your contributions. One, in a higher income tax year, you can do more to charity deductions and then disperse it to charities as you want. And the other thing is, this has been a common strategy, is folks may say, hey, outside of charitable giving, I would take the standard deduction. I don't have enough to itemize. I paid off my mortgage, whatever it may be. And so a lot of times clients we work with will, fund the donor advised fund 1 year and then do their charitable giving from it. Next year they take the standard deduction, maybe the following, and then in year 3 or year 4 they put money in the donor advised fund again and itemize. So you're kind of picking the years that you fund the donor advised fund and you'll itemize on those tax years, and then the other years you may take the standard deduction. So it's a really neat technique. The other nice thing about the donor advised fund, especially for Microsoft professionals, is just we all know this. Most of you that are listening and your colleagues have a pretty concentrated size of holding in Microsoft stock. And the company's done fantastic, right? For the past, decade plus, 15 years. And so as a result, we see a lot of folks that have quite a bit of Microsoft. While that's worked really well, sometimes it's good to take some chips off, right, at the casino, especially as you get closer to retirement and you want less surprises or, possible risks out there. And so one real neat thing about a donor advised fund is you can fund it with your appreciated Microsoft stock. And this creates sort of a double benefit. One, when you put the stock in there, you get a tax deduction as you do if you fund it with cash. So that's always nice, right? You get to save some taxes today. The second item is when you put it in there, there's no capital gains. So, and when you sell Microsoft stock inside your donor advised fund, it's already with the charity for that purpose, right? So it's tax free. There's no gains on there. And so this is a really common strategy. You might, in a bigger contribution year or a year that you're funding your donor advised fund, you could put 30, 40,000 more of Microsoft stock into the donor advised fund. That 40,000 reduces your tax bill as you could deduct it from your income tax return. And then additionally, you don't pay gains on the stock when you sell it in the donor advised fund. So you're avoiding a capital gains tax that you'd otherwise pay. And so when you add that together, that could be a real, high percent bang for your buck tax savings on your charitable giving plan. Okay. I mentioned this in the lead up. Starting next year, part of the big bill is that the first 0.5% of deductions, um, you do not receive a deduction for on the first 0.5% of contributions to charity, right? So if you give $10,000 to charity, the first $500 isn't deductible. That starts next year. So you still have some time to set up and fund a donor advised fund this year, which will both save on 2025 taxes and, a kind of smaller benefit, right, is you won't be subject to that 0.5% deduction reduction. So that's one feature. And another really neat note is you never want to look at your charitable giving from a tax perspective in a vacuum. And so when you're giving to charity, as I mentioned, the donor advised fund or any charitable giving can be really helpful in a higher tax year. You may say, well, this is a normal tax year for me, but I still want to give to charity. Is there anything I could be doing? Yeah, absolutely. You can make it a bigger tax year, right? So you could make a charitable gift to your donor advised fund or outright. And you may say, hey, this gives me some space in that favorable 24% tax bracket. Why not do a Roth conversion? So this is different than a contribution. That'd be essentially converting money from pre-tax IRA 401k to Roth, paying the tax at that time at your tax rate. So if that can allow you to do so again at a lower tax rate than you're typically going to be, that could be a good move to combine those. Same thing goes for a year where you may sell some stock. Funding a donor advised fund can save some taxes and help offset that too. So again, a lot of changes that really can impact your charitable giving strategies to get the most bang for your buck there. I do want to add, it's always good to start with what's my charitable goals or mission. And then from there, we could determine the best way to optimally do that related to your financial plan and tax savings plan. But again, for those that are charitably inclined, there's a lot of great techniques to support your charitable gifts while also setting up your financial plan for the better. So, okay, good. All right, so good. So that kind of sums up strategy to charitable giving techniques as we're thinking about year end. Okay. So that brings us to the third strategy of the five. And as you can see from the visual here, trim smartly. And what I mean by that is sort of managing how to trim and view that target stock sizing and how to best approach it without getting hammered and killed with taxes, right? Which is always top of mind for all of us. Okay. So I know many of you listening aren't Washington residents, but if you are, we have a new capital gains tax that's come into place more recently. And so the way it works is if you show over 270,000 of realized gains, capital gains, and that applies to stock sales, so Microsoft stock in a non-retirement account, then you have to pay an extra, starts at 7%, works its way up a bit of Washington capital gains tax. This does go up with inflation each year. I've kind of seen some numbers that it may be 278,000 for 2025. It's always officially announced at a delay. So I'd probably stick with the 270, right, until we get full clarity on that so you don't trigger it. So again, it's good if you're selling stock to have some numbers in mind so you don't trip over something resulting in an adverse reaction there. Okay. Um, for those of you that are in Washington or not in Washington, we pay federal capital gains tax as well. These tax rates are lower than your ordinary income tax, which is what you pay on, wages, cash bonus, and RSU vests. When you sell stock, you pay capital gains tax on the gains. The 20% capital gains level starts at 600,000 married filing jointly, 533,000 for single filers. So if your total income in a year that you sell stock is over that, the sales over that amount would be subject to a higher 5% tax, so 20% instead of 15%. And so again, sometimes this can act as a little bit of a line in the sand where you're saying, gosh, my Microsoft stocks become a sizable proportion of my total picture, higher than I was initially targeting. I want to sell some, but I want to do so in a tax efficient way. So that might be a level that you look at where you don't want to trip over the, 20% level, right? So you might go up to that point. Okay. Um, Couple other really critical techniques in that front. You want to specify which lots you sell. Because commonly, the reason that you're looking at selling some Microsoft stock in the first place may not be that you've lost confidence in the company. It could be more so that it's become too big of a piece where it could risk your retirement if they have a bad earnings or, we see a change in the AI, infrastructure or, whatever it may be, just doesn't meet expectations, right? When you're a $4 trillion company, to double, you got to go from 4 trillion to 8 trillion a company value. That's just a huge proportion, of the world's economy, right? And so nonetheless, with that in mind, it's good to know what the right sizing and goals are in that front. And so when you sell Microsoft stock and you're doing so on a mission, you want to get the most bang for your buck. And so generally, we'd suggest selling shares that have the highest basis, that are long term, so the least amount of gain. And that allows you to show less gains for every 100,000 of stock that you sell, for example, rather than selling by default your oldest shares, right, where it's all gain. We want to be as tactical as possible there. So yeah, we always recommend specifying what lots you sell to make sure you get the most value in minimal amount of taxes for any trimming that we're doing. All right. Yeah, rule of thumb, just like any rule of thumb, this always varies for everybody based on your situation. But from working with quite a few Microsoft professionals over the years, we typically find that we're able to sell up to a third of your stock holding without too much gain, without it being too painful. Again, it's different for everybody, especially if you've already been doing some trimming over the years. But nonetheless, I wouldn't just have the mindset that, I've been at Microsoft, I have all these gains, I can't sell any, I'm stuck. Um, Generally, most folks we talk to that even been there for quite a while and have amassed large positions, a good rule of thumb is typically we're able to sell about a third without too much tax pain. So again, something to look at. And by the way, when you trim your Microsoft stock, it doesn't mean you have to put it under the mattress and it does nothing, right? We just want to basically add a little bit more resiliency and diversification to the portfolio. And so what's neat is even though you're paying taxes on the stock you sell, you can use those proceeds to fund those different favorable tax advantaged buckets that we talked about. Mega Backdoor Roth, health savings account, regular Backdoor Roth, where yes, while you're paying tax to unlock the proceeds, you're getting a tax advantage in terms of how you invest the money. Okay. Okay. Um, so as we round into the fourth strategy, this one will be pretty quick, but basically we want to avoid tax surprises. One, not many things feel worse than you fill out your taxes in April and you owe $20,000, right? Nobody wants that. Kind of insult on injury is when you got to pay, a $1,500 penalty on the underpayment as well. And so this is very avoidable, right? We just got to do a little bit of planning and diligence. So first things first, here's the culprit. Microsoft, like other companies, the baseline holding on withholding on RSU vests, so your stock restricted stock unit vests, is 22%. Many Microsoft professionals that we talk to may be in the 32 or 37% tax bracket. And just doing the math, if you're only withholding 22%, and you're going to owe 37%, right off the bat, you have a shortfall there. So our best way to do this, and this goes hand in hand with step one to tax planning, by the way, is grab a recent pay stub. This is a perfect time to do that, right? As we're in November, we have one, RSU vest left. Some of you may get a December one. But it's a great time where most of the year's behind you, and we could run a really quick analysis for you to just see how you're shaping up on tax payments. And if we need to adjust your withholding or do an estimated tax payment prior to the end of the year. And so this is really a good baseline and exercise to do. If you make an estimated tax payment by January 15th, yes, January 15th, 2026, right? But that's when the Q4 tax payments are done. That counts as making your payments on time in the tax year, and you could avoid a penalty. One step further, you don't have to make the full payment. As long as we pay enough to reach a safe harbor, we could avoid that underpayment penalty. And especially as Microsoft stocks had a pretty solid year so far. I know it's shown a little weakness here and there recently, but for the most part, it's a good time to do that because your RSU taxable income is likely going to be higher than it was looking to be earlier in the year. And so again, one thing to note on this, even though you could avoid the underpayment penalty, you are supposed to pay the taxes through the year as it arrives. So you may earn some interest on late payment, but still it's nice avoiding the penalty piece, which could be done very well. By the way, just a little plug on this. Getting that pay stub, in addition to figuring out how much tax you owe, it's also really helpful to look at planning opportunities. Should we do Roth conversions? How much should we put in the donor advised fund? And so that's a great starting point just to see where you sit from a tax planning perspective so far this year and mapping out which of these action steps apply to your picture. Okay, good. Okay, good. So, the last strategy to cover here is, so we talked about charitable giving. Beyond that, making tax smart gifts, so these could be family gifts, is also a great technique. Spending a few little bit of time here, you could give 19,000 a year to any recipient as you want, as many recipients as you want, without having to report it against your federal lifetime gift exemption. So you could give 19,000 to each of your three children, right? Even if they're adults, and you don't report it, they don't report it. If you're married, you can do the same for your spouse. You could do 38,000 each. And so, nonetheless, these are good ways to help family where there's a desire or goal to, while also managing future estate taxes, because this can add up over time. Neat ways to use it. You could fund a Roth IRA for your kids as long as they have some earned income. You could put it in a 529 educational plan for your kids or grandkids. The way the 529 works is all the growth in there is tax free as long as it's used for education purposes. If you have some extra in there, it could go into a Roth account. 529 plans, you could actually do 5 years of gifting at once. So if you wanted, 19,000 times five, if I have my math right, 95,000 per any kid's, 529 plan. Technically, you and your spouse can, each do that, right? So you could double that. So there's a lot of room to do these free annual gifts that you don't have to report. And this could really help with future estate taxes as well as helping family or folks that you care about. Because again, if you think you may have a estate tax issue, doing this over a number of years can really move the needle over time. So it's not too late to make your annual exclusion gift. Okay, good. As we're getting close to 2026, it's always good to have an eye to the future, right? So, like we talked about, the big bill, the salt cap increase that goes through 2029, and then we go back to the 10,000. So even though the tax rates have been made permanent until they change, some of these features are temporary. As I was noting, we're going to have different tax laws at some point, right? Which is always changing as you go through different political groups and regimes and situations out there. So you want to make sure that you proactively plan while the low tax rates are in effect. And we'll keep our eyes on this. And as we see new tax laws, just so we're ready and not caught off guard. And so, to kind of sum up that year-end action plan, confirm your 401k, health savings account, Roth contributions. This is the time to do it. Review your RSU tax withholdings and make estimated payments if needed there. Evaluate charitable giving, capital gain strategies. As I noted, the stars have aligned a little bit where there's some real powerful charitable giving techniques we could be doing at this time that marries really well with your Microsoft stock likely growing. So if you're charitably inclined, let's definitely chat on that. And yep, and use your annual gifting. So it doesn't have to be family, but family, friends, people you care about gifts at 19,000 by the end of the year. Um, I know quite a bit here. I try to sum it up into five, key takeaways, but each one's got a number of bullet points. So you may be jotting down notes furiously, trying to keep up with what we covered, what applies to me. Set up a year-end strategy review. If you have a financial planner, print out some of the stuff and take it with them and go over it with them. If you don't have a financial planner, as I've mentioned before, take us up on a no-cost year-end review, and we're happy to go over tax saving strategies with you, as well as retirement strategies, and make sure you're on a good trajectory there. Yep, get a free second opinion on your retirement plan. So for joining us today, you could do that with one of our CFP certified financial planners. Best way to schedule this is you could email or call us. Our phone number and email are on the bottom of the slide here. Or you could just go to our website. There's a big orange button on the top right that says Let's Talk, and that'll allow you to schedule a session with me. where I could help kind of identify how we could kind of best put together that retirement plan for you and other key, planning strategies that are applicable and see where we can help. And so, yeah, make sure to jump on our website today. We'd love to meet with you. I appreciate a lot of you guys took us up on this after our last webinar, which was really fun to see. And so with that, we are going to continue doing more of these presentations in the future. If there's any topics that you're interested in, let us know. We'd love to cover that. We'll keep the information coming with our monthly article on, Microsoft Money Moves that we do at the start of every month. But I hope you found this presentation really helpful. Thank you for your time and have a great rest of your year. Take care.